Mark, I really appreciate you taking the time out of your day to join us here at Rask. Now, there's a lot going on in the world at the moment. I mean, we can say that at any point in time, but right now that feels like an extra large amount of stuff going on in the world in markets. So you must be keeping very busy. What brings you to Australia for this trip?
So we have a lot of very important clients in Australia. We're big investors in a lot of companies in Australia. And for me, as the CIO in charge of all of our global credit investing, it's important to get on the ground insights directly from our clients, directly from some of the biggest issuers in Australia, touch the ground, see what people are thinking here. And as you said, it's very interesting times. There's a lot of uncertainty, disruption. So for me, I've traveled the world my whole life, and this is how I get information and really kind of confirm things that I sense in terms of investment perspectives. So for me, being here is important. It's important for our clients to build our business. We also see a big opportunity in bonds. We think yields are going to go lower. So it's great timing and important to hear from the Australia people and clients.
How often do you get here?
Usually once a year. I tend to do big trips. They tend to be Australia, Japan, sometimes the Middle East, Europe. Tend to travel quite a bit.
Now, can you tell us about your role as the Chief Investment Officer of Global Credit at PIMCO?
Sure. So I've been at PIMCO for 29 years. I've been a Chief Investment Officer for over 10. I oversee all of our global credit investing. So PIMCO is the largest lender in the world in investment grade credit. We have a $2 trillion balance sheet. What that means is that we have tremendous influence. We can lend $5 billion to a single company. Many of these companies, we are their biggest bondholder. That gives us better information. It gives us basically the ability to add a lot of value for our clients. So being big is important in bonds. Being big is a huge edge. We have 85 analysts all over the world. We can write big checks. We can do tremendous amount of reverse inquiry. And we're about to celebrate 25 years of running the fund that I started running in 2000. We've added 1.69% alpha, almost 2% of alpha annually. So we've been able to do something in bonds that very few people in the world have ever been able to do. Great performance track record, but it's really a testament to who PIMCO is, what we can do with $2 trillion balance sheet, with our people, and our investment philosophy.
I guess over those years, you would have been able to build that infrastructure to sustain that outperformance.
Yeah, and what's amazing is when I started at PIMCO in 1996, we literally were 9 people in the trading floor.
Really?
9. And it was a room maybe 4 times bigger than this room, not big at all. Bill Gross was in the middle, and all his traders and analysts were on the perimeter. I was one of them. So 29 years later, here I am as one of the CIOs. But yeah, it's been an incredible run. We're now $2 trillion. We started at $60 billion. But yeah, people need bonds. Bonds provide stable income, security. And right now, yields are as attractive as we've seen in 10 years. So this is a rare opportunity where we think investors can earn equity returns in bonds with a third the volatility. So it's great timing to be here before you to get that message out.
Now, you said you started in 1996. Let's jump forward to 2006. I read that you, in 2006, actually sold your house in California. And not for maybe some of the obvious reasons, but there was some signs in the market that you were looking at and said, hey, I think it's a good time to get out of housing. And you sold your house very fortuitously in 2006 and eventually looked to buy back in 2012. What was the catalyst for the decision? And was it a difficult one to follow through on? Because a house, it's more than an asset. It is a home as well.
Well, I think I tend to do out of consensus thinking and investing. And I remember in 2005, I was meeting with all the biggest home builders in the United States, and I saw a huge problem brewing. I saw all kinds of warning signs. Inventory was starting to pile up. The home builders really didn't have good recognition of who they were selling their homes to. I knew there was going to be a lot of arms reset. People weren't going to be able to afford the homes. The homes, to me, looked 30% overvalued versus income and rent. I came home, I talked to my wife, and I said, we're selling our house. 2 days later, we accepted the first offer and we were out.
Wow.
I went on
was that quick?
That quick. I went on national television 3 times that month, and I said, I just sold my house. I think housing prices will go down 30%. And I even went so far as to say this will be a really nasty recession. I think I used the word bloodbath. I don't think Bill Gross was that happy with that word, but I did call it. And I called it about 6 to 12 months before most people.
That's right. And then 2012, what did you buy a new house in 2012?
I did. In fact, I bought 2 homes and land. And starting in 2011, I bought land, and then I bought 2 homes in 2012.
And for you, was it the investment decision that came first rather than the, owning a house for the family?
It was the investment decision. Yeah. I do everything based on, I try to buy when no one wants to buy, and I try to sell when everyone is buying. So I try to do the opposite of crowds.
Do you bring that into your approach with bonds then?
I do. In fact, today, the market is priced for a 4% Fed funds rate 2 to 3 years forward. I think the Fed funds rate will be materially lower. So I think there's a complete mispricing in the market. I think people think that this high inflation will last for a long time. I don't buy that at all. Companies are your leading indicator. Companies are telling me that growth has peaked. I have a philosophy. It's called slimming down. Over the last 8 years, we got fat. We got fat on fiscal. That fiscal contributed to significant corporate profits, which then created a wealth effect, and consumers spent like crazy. What's the proof statement of that? If you look at the last 8 years, housing prices annually are up 8% a year over the last 8 years. That's huge wealth gains. Equity prices are up 15% annually over the last 8 years. That wealth effect and the massive fiscal stimulus and deficits contributed hugely to corporate profit growth, which then encouraged spending, capital spending, and hiring. All that's changing. Everything. Government is now shifting dramatically. You are seeing a peak in corporate profitability, and you're seeing a peak in spending. So I actually think in my out of consensus view is you're going to see a downshift in growth. And with growth coming down, inflation comes down. I think Trump knows that he has to get inflation down. The key to the American economy is getting those rates down because, frankly, housing's unaffordable today. No one would buy a house today. The cost structure is too high. The only thing that really, I think, supports asset prices, you've got to get that rates down. And to get rates down, you need inflation lower. So I think ultimately we are going to see, with growth coming down, inflation come down. And that will lead to, I think, a pretty significant bond market rally.
And you've seen from the companies that you look into or talk to on a daily basis, you've seen that growth peak. Have you seen it start to actually come off, or is it just flatlining? So
we had every 4 quarters, we have our cyclical forum. And in our last cyclical forum, I kind of debuted this view, this slimming down view, that people got 20 pounds overweight and we all got to go on a diet. The evidence that I think that's happening is if you look at airlines over the last several weeks, they're all guiding lower. What's happening is there's a huge sentiment change going on in America. People are getting less confident. They're getting less confident about their future. They're getting less confident about their jobs. People don't buy homes, big ticket items, cars when they're feeling unsettled. Trump is a disruptor. He's creating enormous uncertainty. People's jobs are now starting to get less secure. Look at what's happening in the government jobs. That is feeding through the economy. And I wrote this paper for PIMCO in 2000, and I said, the title of the paper was Animal Spirits Can Cause a Recession. And what that means is when you pull back confidence, you pull back the private sector, businesses and consumers, they will slim down. So I think we're going on a diet. I'm pretty convinced. Airlines are telling me you're going on a diet. Home builders are telling me you're going on a diet. Auto companies, any big ticket item right now, I think is going to be under pressure.
So that's interesting. You use airlines as a bit of a lead indicator, and because that is where that discretionary money flows to first, or not first, but certainly flows to, and people booking holidays and travel. It's maybe, hey, instead of going to the other side of the states to see the family 3 times a year, let's do it 1 time a year, that type of thing. Is that what you're seeing?
We are starting to see that. And I think what the trigger to even create that catalyst more in a negative fashion is going to be job cuts. We haven't seen that yet. So far, the labor market has held up. Unemployment rate's quite low. But what I've seen through history is when you hit confidence and you hit animal spirits and companies start to pull back their spending, it ultimately does result in less job creation. It results in less capital spending. I'm pretty confident capital spending is peaking in the United States. I also feel like the wealth gains have peaked. So going forward, the tide has gone out. Now the tide comes back in, and that will downshift growth. We think about 1%. So we're going from 2.5% to 3% real growth in the US to 1.5% to 2%. And I would even go so far as to say there's downside risk to that because of the uncertainty, because of this disruption. You know, Trump is really breaking things. And when you break things, people take a step back. They don't make that long-term commitment to buy that house. They don't buy that car. They don't take that expensive vacation. As you said, if they take a vacation, it's going to be driving somewhere. It's certainly not going to be staying in a luxury hotel, spending a lot on airlines.
And so recently you guys wrote a note called Uncertainty is Certain. I'm guessing that's very much around this Trump administration and what we're seeing now. Can you tell us about that?
Well, I think at the end of the day, Trump is a disruptor. He's breaking norms. If you looked at the United States over the last 70, 80 years, U.S. military strategy was all about alliances and allies. And even that now is looking at, Trump making more of our allies pay more for defense. So a lot of this is breaking down. Some of it is for political reasons. There are people who believe that, others should pay. So I can see a lot of this being very rational, but at the same time, it can be what the party wants, but that doesn't mean it's not disruptive.
Yeah, so I think big shift from the norm.
Huge shift from norm. And also look at what's happening to the government sector jobs. I mean, we haven't seen this level of gutting or potential gutting of government jobs in a long time.
So what does this uncertainty and these policies mean specifically for credit markets?
So this is interesting because typically when you have an economic slowdown or a recession, you get fiscal and monetary to come in. For example, COVID, the government came in 10, 12% deficits. The reason why the U.S. had this huge wealth effect, not only with homes, but equity, it was all related to fiscal. U.S. was the largest fiscal stimulator as a percent of GDP. It doesn't surprise me at all. That's where the profit boom was. Doesn't surprise me at all. That's where the equity bubble was made, the housing, et cetera. That's reversing in a major way. But what's important here is Trump's going the other way. He's not trying to expand government. He's trying to shrink it. And that tells me if there is a growth slowdown, if there is a potential recession, it's not the government that's coming in this time. This is not a health crisis. So you're going to have the Fed have to cut rates a lot. And right now, this is where the opportunity is. The market is pricing Fed funds 2 to 3, 4 years forward at 4%. That's way too high. I am seeing already huge evidence that the interest rate sensitive sectors of the economy are plateauing and slowing. So there's parts of the American economy that can't take higher rates at all. So the entity that's coming in is not going to be the government this time. It's going to be the Fed. And the first move will be to lower funds rate, which will steepen that yield curve. So that's why we think that bonds are very attractive, because the market is mispricing potential growth slowdown and mispricing forward Fed funds rate. People think inflation's going to stay high forever. I don't buy that at all. As soon as growth slows, you have a recession, inflation will come down.
So you don't see tariffs affecting inflation?
I think tariffs absolutely will be near-term inflationary, but you have to look through that tariff, and then you have to really ask yourself the question, where are corporate profits going? Corporate profits and companies are your leading indicator. So if you hit corporate profits hard, which I think we have the potential to do, you will absolutely hit capital spending and job creation. And there is no way inflation stays here when people start losing their jobs. Inflation is going to ultimately come back down. So profits lead growth and growth leads inflation.
I'm curious then, based on this view, are there any sectors or regions that you're avoiding as an investor, and what opportunities is the team seeing at PIMCO?
So regionally, and this is just the fact is that the U.S. equity market has massively outperformed. My personal view is you want to take less U.S. equity exposure now, diversify it more into Europe, where valuations are much more attractive. At the same time, Europe is now spending on defense. So while we benefited from this massive government spending out of COVID in the U.S., that's reversing. Now you've got Europe kicking in. So shifting more exposure, particularly more equity beta to Europe, makes a lot of sense to me, particularly European banks, as well as the defense contractors. And then in terms of the U.S., being a lot more cautious, like we talked about, on these discretionary purchases. I really believe that we have gotten a little bit heavy in the U.S. We all need to go on a diet. And I think given the uncertainty, consumers are going to pull back on those big ticket items. So for the first time in 19 years, I'm actually shorting things. And I haven't done that. I've been at PIMCO for 29 years. I haven't shorted things in 19 years. So the fact that I'm shorting things today tells you that I see warning signs. Shorting home builders, shorting autos, shorting retailers.
Wow. So zooming out and shifting to the other major regions, we've already touched on Europe, but say, what's the outlook for say, Asia and specifically China for yourself?
So, China is a place that we've invested. PIMCO started in 1971. Early in my career, when I joined PIMCO in 1996, a lot of travel to China, a lot of travel to Russia. We're investing less in Russia today, but we have been very large investors in Macau, for example. One thing I can tell you from investing in gaming for the last 25 plus years, Chinese like to gamble. There's only one place you can gamble, Macau. It just went through one of the biggest tests in history, a huge property unwind, and yet Macau made it through fine. So I do think that China, all things equal, is picking up. The equity valuations look cheap there, particularly relative to the U.S. So I think from an investing perspective, it makes sense to move some money there.
And so from a sector-specific insights, what trends in bond issuance are you identifying at the moment, and where do your trading desks see that opportunity now?
Well, the issuance is really going to be coming out of the government to fund these 6% deficits. So despite Doge, the government's not going to be able to cut all that much. Sure, Trump can take out some jobs here and there, but in terms of gutting spending, it's not going to happen. Congress ultimately has constraints on that. So what this means is that when you're running 6.5% deficits, you're still going to get a lot of bond supply out the curve. We're most constructive on the front end of curves. Really, it's that 3, 4, 5 year part of the curve that's most attractive. Our bond fund yields today roughly 6%. A little bit plus or minus, some 5.5, some 6.5. But we actually see the potential for 7-8% returns, because as you get those lower yields, you get price appreciation on bonds. So this is a rare time in history where I can talk to you and say, look, investors can not only earn high yields are as high as they've been in 10 years, but we now have catalysts in place for bond price appreciation in addition to high yields. So this is extremely attractive to be a bond investor today. We would even go so far as to say bonds can match equity returns now, given where they're priced.
Given that it sounds like quite an optimistic view on the returns, the near-term returns of bonds, what are you worried about? What is causing you worry in the portfolio what might upset that?
Well, we have been shifting our credit risk down over the last several years. We've been building up resiliency. We've been moving out of cyclicals into non-cyclicals. We've been moving out of these big ticket item purchases into things like telecom, healthcare, and utilities.
Utilities, yeah.
Much more defensive. We still like the aerospace and defense industry and some select energy investments only because of the secular tailwinds. Make America great is going to make American defense contractors and American energy great, particularly LNG. But outside of that, we want to de-risk the credit side because we do think that the probability of recession is gradually starting to pick up. By the way, that should be very good for bonds, not necessarily great for equities.
Right. So we'll talk about bonds historically through times of recession. How have we seen them perform? What should investors be looking for during a recession from their bond portfolios?
So this is what I'm very proud of to work at PIMCO, and it's really a privilege. We tend to do very well in recession. We are very defensive. We're very disciplined. We tend to take that longer term view. Because we have such amazing relationship with companies, we have leading indicators out there that are telling us whether we're heading into recession or not. My gut tells me that the risk of recession is rising. So again, we can shift those portfolios hopefully a little bit earlier than some of our competitors who maybe don't have as good of information. But we're actually, believe it or not, super excited about disruption and the potential for a recession, because this is when we perform best. If you look at, for example, the 25-year track record that I mentioned, almost 2% of alpha, we do even better in recessions. So we outperform our peer group. We outperform our benchmarks even more than that in recessions. So we actually love this environment. Disruption is a good for us.
And why is it that you guys can outperform during those periods? Is it because of the inefficiencies in the broader bond market, or is it just from the structures and systems that you've put in place, and you've got more boots on the ground, visiting more companies, getting more information?
I think it's exactly that. We also have a lot of checks and balances in the system. We have quantitative teams, which are looking at valuations, and risk management teams. PIMCO is very strong on risk management, so we never tend to get over our skis too much. But in general, I would say it's exactly what you said. We have leading indicators coming from the fact that we're one of the biggest lenders in the world to companies. We leverage those relationships to get early insights on what's actually happening all over the world with airline ticket prices, with forward bookings for hotels, with whether or not people are actually buying a home or not. Here's something fascinating. The average incentive for a home builder in the United States is 2 to 3%. Today, home builders are having to give incentives of 9 to 10%. Some companies are giving 14% incentives.
Can you tell us what an incentive means?
An incentive is typically a substitute for a lack of affordability. So in other words, when everyone wants to buy a house and mortgage rates are low and housing prices are cheap, home builders don't have to give any incentive because demand is soaring. But what happens as housing prices go up a lot, which they have, and as those mortgage rates have gone up a lot, which they have, affordability falls off a cliff. And all of a sudden, you can't clear that inventory without discounting it. So an incentive is a discount to clear the inventory. And the incentives right now are as high as I've seen. So that tells me you have a demand problem. So people say, oh, you can't hurt housing. I don't buy that at all. People say the high net worth person doesn't pull back. I don't buy that at all. So, and what's crazy is that I have been to conferences less than a month ago where that was the consensus. The consensus view was we're higher for longer. US rates are not going down. You can never break housing. You can never break the consumer. Well, it's not what I believe. I believe you can break the consumer.
That's fascinating. It's quite interesting hearing. So I had to stop and ask you what were incentives, because here in Australia, our housing market, the demand is certainly, it always seems there, and our housing is very unaffordable. There's been lots of it's a political football right now. I'm not sure if you're aware of that. So that's really interesting to hear that perspective, because it's certainly not been something at all in the Australian mindset. Can we talk about the benefits now that this active management brings? Because PIMCO have launched a number of actively managed bond ETFs here in Australia. So if you're comparing it to what you're getting in a passive investment structure, how would you compare and contrast your investment style then to the passive bond ETFs that people would be familiar with? So,
we have a 25-year history of outperforming the market by almost 2%. What the ETF universe allows us to do is pass that on to the retail investor. We've been investing in ETFs for 25 years. We're the largest active bond manager in the world. We've launched 4 ETFs in Australia, including one off of the Global Credit Fund, which Rob Mead manages here. And we feel like this is a great way for retail investors to get access to PIMCO. If you look at just the industry, fixed income ETFs, 79% of managers outperform the benchmark. Equity, it's only 44%. So it is easier to beat benchmarks, we feel. And that's the benefit of active management. But at the end of the day, what's the benefit? We've been doing this for 25 years in the global credit markets with almost 2% of outperformance. 2% is a lot. So if you start with an initial yield of 5 and you can outperform by almost 2, that's 7. 5 to 7 is a big deal. So, we can offer that to retail investors here in Australia, and that's something we're very proud of.
Now, let's look to get into a couple of these final questions. There's a few that we always ask every single guest, but there was something I've been meaning to ask you because in the introduction, I mentioned a couple of the positions that you're in. One of them is on Google's Investment Committee Advisory Board. I was fascinated by that. What does that actually mean? What does that look like?
So it's really, again, another honor. It's an honor to work for PIMCO. It's an honor to be on Google's Investment Advisory Committee. But, they're sitting on a lot of cash. I won't tell you the exact amount. But we advise Google on where to move that money. And we have been advising them, as our other clients, to move into more bonds. We believe that rates are going lower over the next several years. And I think the reason why Google asked me to be a part of their committee in 2016, so I've been doing this for 9 years, is because, we are the eyes and ears of companies all over the world. And while Google has obviously great information and technology and in certain industries, PIMCO sees it all over the world. We have 85 analysts. We're, again, the largest lender to investment-grade corporate bonds in the world. So that gives us, unprecedented relationships so we can give Google insights into what we're seeing in terms of these leading indicators. Is the economy picking up? Is the economy slowing? Is inflation picking up? Is inflation slowing? Here's something fascinating. About 4 years ago, my analysts told me we were going to have a huge inflation problem. None of the macroeconomists were saying that. Even our own internal analysts, macroeconomists, weren't saying that. But my analysts were telling me we are seeing unprecedented cost structures go through companies, and companies have no problem whatsoever to pass that through to their underlying constituents. And guess what? It didn't matter where you were in the world, and it didn't matter what industry. I'm talking about broad-based ability to raise prices. I had not seen that in my career. So that told me early on, we were going to have a huge inflation problem. So these companies are leading indicators, and these insights are incredibly valuable.
How many analysts do you have under you?
85.
85. How do you manage 85 analysts?
You got to get up early and stay awake late, not sleep much.
So let's get a couple of key takeaways for our Australian-based self-directed investors. How should they be thinking about the current market then, given the landscape that you've just put forward to us?
So again, we think bonds are as attractive as we've seen in 10 years. This is a rare point in history where bonds can earn near equity returns with a third the volatility of equities. We see growth slowing. The catalyst for inflation coming down further is that growth is likely going to slow. That's going to allow the Fed to take rates lower because right now we view the rates as restrictive. And the market is mispricing this. The market sees higher for longer. The market sees inflation staying high. And the market sees the U.S. economy as probably being a little bit more resilient than PIMCO does. So if I'm right on this theory that the rising tide lifted all boats, and as we reverse that trend, we slim down, with all this uncertainty, businesses and consumers pull back their spending a little bit, you'll start to see that in the data. You will start to see companies, I think, be a little bit more cautious, cut guidance a little bit more. And that will be the catalyst, I think, which causes bond yields to rally.
And how long, because equity-like returns in bonds is highly unusual. How long a period of time can that last for?
We think 2 to 3 years. So basically, we're set up now.
People haven't missed the boat.
No.
Okay.
But it's important to act before the data actually slows, which is why I have extended durations. So I'm very bullish on bonds now. I'm running above index durations. You have to Can you explain what that means? So what that means is that my portfolios will outperform if rates come down relative to the peer group and relative to the benchmark. So I am sticking my neck out today. I'm running above index duration. I'm not just talking, I'm doing it in the portfolio. My positioning reflects my views. I do think the growth is slowing. I think inflation is going to come down and the Fed will be cutting. It may take the Fed 6 months to start, but if you look at what the market's priced, I think the Fed's got a lot of cutting to happen, particularly if growth is slowing the way we see it.
This is really interesting. And what I'll do after this is actually get a link and place it in the show notes where people can maybe stay up to date with your views and your insights, because I want to click on it. I want to hear more about this as it unfolds. So the final question, Mark, that we ask absolutely everyone who appears on our shows is, if you could go back in time and tell your younger self one thing about investing, business, or life, what would it be?
So one thing about my job is I can't sleep much because it's a global job all over the world. I'm up at 3. I'm checking emails until 8:30 at night. So I do sleep 5-6 hours. But what's allowed me to have this career and do this for 29 years is a commitment to nutrition and exercise. I believe very strongly in longevity, and you have to put in the work. You have to be in the gym. You know, I probably do 13 to 14 workouts a week.
Really?
Yep. I spend a tremendous amount of time in the gym. I do weight training. I do cardio. I do abs. I do pretty much everything. Yoga, stretching.
Traveling must be really hard.
I was in the gym for 2 hours this morning. I was in the gym from 4:30 to 6:30. So it really is a commitment. Yeah. When I say I'm committed, I'm putting in the work every day.
I get that. Yeah.
And also, one thing I've learned is nutrition. Cutting down on alcohol, not necessarily eliminating it, but keeping it to a weekend thing. And being very, very healthy with your diet. That means no processed foods, no junk food, no sugar. So I'm what you call exceptionally disciplined. But if you look at, biologically, I'm 55. I feel like I'm 30. And if you ask people at PIMCO, they'll tell you, well, he'll be here another 25 years because I just have that energy level. And that energy level has been a huge commitment to fitness, a huge commitment to nutrition. And that's the advice I would give young people is put in the work, and don't just put in the work in the office. You have to work outside the office because you can't work 17-hour days unless you have energy. And the way to get energy is to take care of your body through nutrition, through exercise.
You must love it as well.
I love it. I don't have kids. And everyone at PIMCO, I always say I have all these portfolios that I'm running, right? And I was like, well, that's my firstborn, that's my secondborn, so yeah, this is my extended family. PIMCO is my family, and I plan on being there a long time.
That's fantastic, Mark. I've really enjoyed this conversation.
Same.
I really appreciate you stopping by and checking in with us. And we would, when you make that journey over to Australia in 12 months' time again, we'd love for you to come in and join us again.
Sounds good. We'll check in on the slimming down, how we're coming.
Yeah. Are you referring to the slimming down of the economy or me? Because I now feel like I need to go and do some sit-ups and push-ups. I'm the inverse of you. But Mark, really appreciate it. Thanks for me.
Thank you. Cheers. Appreciate it.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.